Hello, everyone. It's Ted Bader here, president of SIA Wealth, and wanted to thank you for dialing in and listening to this webinar, which is going to be a market update from Jeremy Fehr. I just wanted to, make sure everyone, we wanted to say from SIA Wealth that we're very concerned about everyone's health and safety. We hope everyone's taking the proper precautions. We hope that this shall pass shortly, but in the meantime, we all need to manage our portfolios and our client expectations. So we wanted to give you the most timely information as possible. So today's webinar is going to have Jeremy speaking for most of it. He's going to be talking about the bear market bounce or bull trap, as we've seen yesterday and today. And what does this mean and what are the charts saying? He's going to also address some of the most frequently asked questions. We have been getting, as you can imagine, a lot of questions from concerned advisors, and we're going to address a first one: how bad can it get? When will we, SIA, he means, get back into the market? And what is going on with the US dollar versus CAD? Then he's also going to talk a bit about current charts, and I'm going to wrap it up with a call to action in terms of what we can do in portfolios to help mitigate any potential downside or participate in potential upside. So what we're trying to do here more than anything is understand that SIA Wealth is a tactical manager, and we're not making long calls. We're following the money flow as it gets allocated. And right now, I think there's just a lot of confusion going on, and what we hope to do today is to clear up some of that. So without further ado, I'll pass it over to Jeremy.
Thanks, Ted, and thanks everyone for taking the time today. We know it's an extremely busy time communicating with clients, dealing with all the issues of isolation for yourself, with your family. So we appreciate you taking the time, and we want to stay in contact with you. Today's webinar is designed to give you some information, to give you some communication that you can use with your clients and give you some confidence, especially in the extreme volatility that we've seen, certainly almost unprecedented in the amount of volatility we've seen over the market in the last couple of months. But we'll jump into it. Wanted to start today with bear market rallies. So yesterday and today, again, we've seen some extremely strong rallies into markets. So we want to take a look back historically and see what these bear market rallies can mean. So we've got 10 situations on the screen here. So these are the best 10 days that have happened in previous bear markets from January 3rd, 2000 right up until March 7, 2014. We can see the first two are based on the 2002 bear in July 24th and 29th. We can see that we had returns, both of them of over 5%. And what we highlight on the right-hand side is going to tell you from the top or from those levels, how much did the market go down? So we've seen strong bear market rallies over times. How frequently do they end up being the bottom of the market? So we can see in 2002 that there was a couple of occasions. The lows ended up being in March of 2003, so well off of there. And there was additional losses, including eating away from the returns on that day. 2008, 2009, we have another 8 situations where we have extremely strong rallies. I think the only replication we can have to today and yesterday's rallies really happened in those October 28th and October 13th. We see 11.58% daily rally on the 13th of October 2008, and we see 10.79 just a couple weeks, not even quite a couple weeks later. We see another 10.79% day. So extremely strong rallies, and for most of us, we were in the business at that time. What's really important is how much the markets dropped after that, 32% from the 13th of October 2008 and 28% from the level of October 28th back in 2008 as well. So there was another few other tries we saw early on in September. There was a 5.42. In November, there was 3 tries where we had over 6% on each of those rallies. Didn't end up being the bottom on that. The final 2, we did see the bottom on. So March 9th of 2009 ended up being the low of the market, and we see that we had a 6% rally, followed a couple weeks later with a 7% rally. So those were part of the bottoming process, but generally speaking, in our experience, and I was just noting now that this is the seventh crisis that I've gone into that reached bear market status, and in all situations, these types of strong rallies, for the most part, have not been the indicators that have given us the confidence that we can go back into the market. So 8 out of 10, the gains were erased and new lows reached, and the 2 out of 10, the best days were near the low of the bull in 2009. So with that, I wanted to move on to some questions. So this presentation today is going to be more sensitive to information that you've been asking of us. So that certainly with yesterday's activity, we had a lot of comments on previous bull market or bear market rallies and what that looked like. So we did that slide. But one of the biggest questions that we're getting is, how bad can it get? So I pulled it up. I did this on our previous update here 1 week ago today. And this is the SIACharts Market Equal Weight Index in 2008. So we have a date of March 9 being the low of the market, which is highlighted at the very bottom of that arrow there with the top there. So what we notice is that we have a 47 box reversal on this. So this is a 2% chart. It's based on an equal weight index. So we do this because this is largely how we measure cash flow analysis, is through an equal weight basis to see how investments are doing. We can really see that that bear market was catastrophic to most securities during that time. The benchmark indexes did better than equal weight, but we can see that there was a 47 box reversal on that equal weight index over the life of that bear market, which started really, the highs were seen in July and then again later of the year in 2007. What's also interesting is that we see during that bear market that there was 6 rallies of greater than approximately 10% or greater that all failed, and we hit new lows on that again. So it's just food for thought on quick recoveries. They tend not to work that way. We can look at the chart there and see that in December of 2008, we saw a strong rally right up into January, and new lows were taken. So that was the biggest head fake that happened during that time frame. But we have to be careful of those and talk to our clients about it as well. So what would that look like today if we had a similar bear? And again, I'm not saying that we are going to see the levels that we saw in 2008. The red highlights where we were sitting as of the close yesterday. Today's activity is not included in it. So you can see how far we've dropped. If we were going to replicate the same amount of drop that we saw in 2008, the yellow zone would see the remainder that would come off of it. So to date, as of yesterday's close, we had 19 box reversal out of that 47. So I don't suspect that we will reach those levels, but you just don't know in a bear market status. That's why we're in the red zone. Large pools of capital are really looking for central banks and governments to rescue the day. So that's potentially some of the danger that we can see in the market. I think probably a better indicator for you to talk to your clients about when you're dealing with SIA Wealth Management is really our equity action call. And what we've highlighted here is our green zone returns, our yellow zone returns, and our red zone returns. So these are the returns that we've seen in the equity action call from its original date back in June 2000, or later, a little bit later, June 6, 2006, right up until September 30th, 2019. So that's looking at the 08 experience, 2011, as well as 2016. So when we see the red zones, the average downturn in that is minus 22%, a little bit more for both the S&P 500 and the S&P TSX composite indexes, which really highlights. So some people were commenting that maybe we were a little late to the game getting in the red zone, but that's already baked into the cake on this red zone analysis, is that we're not getting the absolute top of the market. That's not the absolute downturns, but we had 2 of those red zones that ended up not being that severe. You know, what the activity that we've seen in this bear market activity is more in line than what we saw in 2008 with the severity and the uncertainty that comes around it, and certainly the crisis that we all find ourselves in. So this is, I think, an important graph for you to speak to your clients about, to give them more confidence in what you're doing. Another question that we get asked quite a bit is, you know, will we get back in time? So I've just highlighted on the screen here, using again that SIA Market Equal Weight Index, showing the activity to yesterday's close. But what I've done is in the bottom left corner there, I've highlighted the 2011, a little bit up in the middle of the page. I've highlighted the 2016 red equity action calls and the time it took for us from the bottom to get back in. So I took the larger of the two was the 2011, late 2011, right into January of 2012, when we went back into the green zone, and I just put those on the screen there. So if you look at, for example, the top, if what we saw with yesterday's activity, what we're seeing with today's activity ends up being the bottom, generally speaking, and there's no guarantees in this, it is a very sophisticated system, but roughly speaking, where that question mark is in the top would highlight where we would expect to be close to or near the green zone based on our historical use of the equity action call and how it monitors the market. If we look in the bottom right corner, we can see a hypothetical example showing if we fell as far as we did in 2008, where that recovery would be. So again, we're not getting the tops of the market, we're not getting the bottoms of the market, but we tend to stick in those ranges when we're making those decisions. The final question that comes up a lot is what is happening with the US dollar versus the Canadian dollar. Since last week's update, I did do an update on this Wednesday last week. We have moved up a couple of more X's. We are now sitting right against resistance, and to be expected, we are seeing a pullback in yesterday and today's activity. Support really sits above that 139.19 level, and we would expect that to be reasonably solid support. There's certainly a lot of motivated parties within central banks to loosen up the US dollar, to weaken it against their currencies, and the US, obviously Federal Reserve, they don't want to make it too expensive post-coronavirus crisis for them to export their goods and services around the world and repatriate funds from those sales. So looking at the chart, we are seeing resistance. We still remain very bullish in a US dollar pattern. I will highlight, which I've done on a number of occasions, that we have shortened our USD CAD rules because there has been intervention by the Federal Reserve and other central banks in it. But again, at this moment in time, we will remain bullish. The only product that holds US dollars within our full prospectus products is the BMO Tactical Global Equity ETF Fund. That is sitting in US currencies. Our other products are sitting in Canadian denomination, so there's no currency risk in those. So that allows you as our clients to make a decision whether or not you want to have that US dollar exposure or not. But we would expect to pull back into that, maybe that 140 range, and from there, if we get a breakdown in that, would reevaluate that position. So we're going to move into, again, more of the standard focus that we do on these webinars is what are the charts telling us? So the equity action call, this is as of yesterday's close. If you look at the red circle in the bottom right corner, you can see a little hook there. We did see some positive movement in the equity action call. We remain red at this time, so we are going to remain defensive. If you look back to the left, you can see times where we stay in the red, you get bumps up, and then it doesn't end up getting right out of there right away. So generally speaking, there is time, especially in a larger crisis, which this crisis has more in common with what we saw in 2008 than what we saw in 2011 and 2016. So this is not enough to get excited about. We'll see what happens with today's activity. But again, what it appears to be to date is just a bear market bounce, which can be a bull trap. The asset class rankings have adjusted from last week. I think most notable of this is that we see bonds moving to the third position. This is largely based on some of the credit issues with some corp junk bonds have dragged that down. So we're seeing pressure on bonds in that has moved from the first position down to the third. So now we see the most liquid of asset classes. We have currency on top, cash in second place. So this really shows where the money is being parked. In other red equity action call situations, we would see bonds ranked much higher as people go to look for some return. or commodities ranking significantly higher. We did see a big bump in gold, but overall commodities have remained weak up until yesterday's activity almost across the board. So we can see that most of the money is being parked in short-term instruments, both in domestic and foreign currencies, to prevent any risk to themselves in the market today. The first chart I want to look at here, and again, in the original part of this presentation, I was showing you our equal weight benchmarks. In this situation, I'm going to show you the cap-weighted S&P 500. We are approaching resistance as of yesterday's close, so we've got a 4x reversal in the chart based on yesterday's activity. Extremely strong performance. We've seen that before. Resistance is at 25.20. We are looking at levels right now, if the market sits very, very close to exceeding that level. So we'll see how the market closed today. We might get through resistance. There's a second level of resistance, which will be much more significant, which is 26.22. So we'll watch that closer to see if we have any issues from there. To the downside, any movement below that 21.94 level or 21.09, both of them are close together, but any move through the lows would suggest potential another down leg for us in the market. So we'll be watching that closely as well. Yesterday's activity did not increase dramatically. The short-term indicators, our SMAX indicator remains a 4, so that's another area we'll be watching. The S&P TSX Composite had an extremely strong bounce yesterday. It was approaching, as of yesterday's close, the 12,941 level. Sits as resistance. Sitting there with today's activity, it will be well above that. Much more strength has been seen in the TSX today than the U.S. markets, but the big test is going to be that 13,734 level. We would look at that as key resistance. We might be brushing under that. Again, we'll have to wait and see how the market closes. To the downside, we really got to watch that 11,045 level. Key support at that point, which goes back to the 2011 situation lows, and we'll see whether or not we breach that or, over the coming weeks. The final chart on the equity side is the SIA International Equity Equal Weight Index. International has been of note, stronger than both U.S. and Canadian in our asset class rankings. This is something we like to watch for when we think of what the backside of this bear market could look like. International equity being ranked higher, it has not done that for, going back through that 2008 timeframe. Only momentarily has it ever been in a situation like that and then lost it. So we're watching this very closely for continued strength. Is that short-term relative strength that we're seeing a function of the governments over there and the people over there have internationally have seen the COVID crisis go through their countries, specifically China, which is ranking very strong as an individual country. You can think of South Korea, Singapore areas over there, even Australia and parts of Europe have seen more of it, with the West, North America, to be receiving the COVID crisis last. So we're watching that. Resistance is at 27,096. Support is 24,541. So again, a reasonably tight range for this one here. We'll watch that very closely and report back to you. Crude oil, since our report last week, our webinar last week, broke through support, going right through 1997 support levels. So quite a dramatic downturn on crude, certainly having at least a short-term dramatic effect on Canadian companies, and we'll see how that resolves going forward. We did see a reversal back up again a few days ago. We saw a strong day where crude bounced extensively right up to that 25 level. We now see resistance at that 25.93. We'd look to see that high taken out to give us some indication that crude might even have a short-term bounce from here. To the downside, we're watching for that 2047 level. There is, again, not much support that we can grab onto below that, so we'd be looking at the bottom of the chart for that, probably 6 or 7 O's beyond that level. So we'll watch that 2047, 25.93 range to see where crude goes from here. Copper, which I highlighted last week, known as the global barometer, seems to have shrugged off the bounce that we've seen yesterday. We have seen a little bit of positive today, but not as dramatic as we thought. It has weakened since last week. A couple more O's were put into the chart, approaching really key support above that 199 level. If we see 199 broke, that would be considered bearish for us and offer up opportunity into the 170s and even into the 140s if it doesn't correct quickly from there. To the upside, we're watching for 238, and key resistance is going to be 260. So again, a lot of work on this chart as we've seen on all the other ones over there. But it is interesting to see that copper has not shown the strength that we would expect given the rallies we've seen the last couple of days, if these are to be sustained and be nothing more than a short-term short squeeze for investors who have been short the market for some time. With that, I'm going to turn it back over to Ted Bader, and Ted is going to talk a little bit about how SIA can help you from here.
Thanks, Jeremy. And for everyone listening in, I also just want to highlight, you know, we're following the system. This is a period of very high emotion, shall we say, because this is something that affects our family, affects our lifestyle. And all we're trying to do here with SIA is follow a process and a system. So it's very important to understand that we're not predicting what's going to happen. We can't. And whatever will happen will happen. All we're trying to do is act in the best interest of clients and ourselves and try to manage that downside. If we see the opportunity that's bouncing back up, we will eventually participate. And if it continues on down, we've stayed out of the market. So understanding where SIA fits is an important aspect when you're creating your portfolio. So we kind of highlighted a few different charts here as a call to action. And I've had lots of conversations with advisors over the last few weeks about where does this fit and what am I going to do? You know, maybe you've held on and you've seen a nice bounce in some of the equities that you've held on to over the last couple of days, but you're worried about the next few weeks or months. So some advisors are starting to raise a bit of excess cash, and the question is, what do we do with that? So here's an opportunity to make a 20%, and I say this because the numbers work. Of course, everything changes depending on your individual situation, but here's a 20% allocation of your equity exposure to some of our equity funds. So assuming you have a 60-40 client, a 20% allocation to one of our equity funds, either the Tactical Global Equity, the SIA North American, or the Canadian Focused Fund as well, it would give you an opportunity. Today, you would be owning 40% equities, and the rest of your portfolio would be 60% fixed income and cash. That is because that equity fund, the 20% allocation, would have zero equities in it. So that's when I say this is real, what is in the portfolios versus what shows up. So it shows up in your client statement as an equity fund. So your client sees 60-40, your compliance sees 60-40, but in actual fact, you're actually 40-60. So this is an important aspect because it gives you an opportunity to prepare a bit for if you believe a downside is coming. Also, it prepares you a bit to have a tactical sleeve. So this is where we are today. And a lot of advisors have taken some excess cash and reallocated it into one of our equity funds that has zero equities at this time. The other side is a lot of advisors who are looking to sell off some equity positions right now just to reduce risk and manage a portfolio, are also looking into this as an option. The benefit of having an allocation to these equity funds is when eventually we kind of work through and getting back into the green zone. So if you want to flip to the next slide. This is an example of what happens when we do get back into the green zone. Again, if you have a 20% allocation to our equity funds, when we get back into the green zone, those funds become 100% invested in equities. So we are a tactical manager. When I say we go from 100% in the green zone to zero in the red zone, you've seen this in action over the last couple of weeks, and that's exactly what we're going to do. So you take a client who's, again, 60-40, of which in the red zone right now, you're only 40% equities. When we get to the green zone, you will get back up to that 60% equity allocation. So this is, again, without you having to sell positions, without you having to try to manage that risk during an emotional time. So that's quite important to understand. Jeremy highlighted in his charts how quick we could potentially get back in. Of course, we're not going to time the bottom, but we try to make our signals as sensitive as possible, and we try to minimize the loss, but we want to make sure that that trend is in a positive way. That's why we wait till the green zone. So what you can see here is that we get that exposure and fully invested once we get back into the equity action call. So the next slide shows you kind of a summary of it. Currently, if you have a 40% weight in equities, so these are positions that you've already held, stock positions, fund positions, ETF positions. We're not saying to switch your entire equity position. What we are saying is to potentially allow a tactical sleeve of 20% into our equity funds, which will, in the red zone, allow you to go to 40% equity, and in the green zone, allow you to get back up to 60%. So the red and the green zone I'm showing at the bottom, the totals, that's real. It's actual. You have that type of 60% equity exposure in the green and 40% equity exposure in the red. What your client statements show is a 60% equity exposure for both green and red, because they will be owning an equity fund. And that's really important to understand, because you're not trying to get offside. You're trying to manage the risk as best as possible. But we have had a lot of clients who have had excess cash in the last while, and it becomes quite difficult because you're offside a bit on your investment policy statements. So that's how to include SIA as a tactical sleeve for equity. The last thing I want to mention is in a balanced fund, and this is where that yellow zone comes in. The equity allocation is basically going from green to red, but here is our balanced fund, which is our BMO Tactical Global Asset Allocation Fund. If you look at a 25% allocation to this fund, that's a large allocation, but the point is it makes the numbers work. In the green zone, you're at a 60-40. And then if we're in the red zone today, your equity exposure is only 45%. And right now, that's exactly where your equity exposure will be. It's 45% because our balanced fund has zero equity exposure currently. Now, again, that's very important, and to understand where that tactical sleeve comes from, as we go through the yellow zone into the green zone over the next, hopefully, weeks or months, you will slowly increase that equity allocation, maxing out at that 60-40 that is in your investment policy statements. So we've been talking about this for a while with advisors in terms of incorporating a tactical sleeve. And really, in a bull market, it's very difficult to incorporate it because everything's been going well. Now is exactly the time to have that conversation about where a tactical sleeve fits. Now, whether it's 15% all the way up to 25%, that's up to you to decide. But we're more than happy to show you where those kind of allocations can change depending on the size of the allocation you make. The point is, if you're following SIA, if you're using it in your regular book of business, this is exactly where we can help, and this is why we created these funds. For that portion that you want to be tactical, it will do it without you having to go to a client and say, okay, we're going to sell these positions or we're going to add to them. It takes that emotion out of the conversation, and that's really quite important in terms of what we're talking about today. That's what I wanted to highlight right now. If there are any questions, I should have said this at the beginning, but feel free to type in the questions as you get to it, and Jeremy and myself or Paul Vendrinsky is more than happy to help. I'll kind of have a quick look at some of the questions. One of them that just popped up, so our asset allocation fund has 45% equities right now. No. Sorry, Jeremy, could you go back to that last slide we had? This is taking a hypothetical example of a client that's 60-40. So if you have a client that has 60% equities and 40% fixed income, and you add a 25% allocation to our global asset allocation fund, which has zero equities right now, your total equity exposure for that 60-40 client would be 45%. That's what we're talking about by having a tactical manager. As we go from yellow into green and we get invested into that global, we invest back into equities, your equity exposure would then go back up to that 60%. So we were talking about a whole portfolio. All of our funds, all 5 of our BMO funds currently have zero equity exposures right now today. We have no equity exposure whatsoever. It's important to understand.
So this would be your other holdings that you have in that portfolio outside of SIA. But we're a great balancer. In between your allocation of 60-40, it's a way for us to do the reductions for you, and both to the defensive side and to the offensive side.
Yeah, exactly. And actually, someone actually just brought up a good point. If you're looking to, how should you allocate? Does the global equity or the North American or the Canadian make sense? And that's actually a very good point. I should have highlighted it. If you go back up one slide, Jeremy, our global equity fund is the only fund in our lineup that is in USD right now. So it has US dollars. Our Canadian and our North American is exposed to Canadian dollars. So if you do not want to take on currency exposure, look at the North American or the Canadian fund. If you are interested in having a bit of US dollar exposure because it's ranked high right now, then have an opportunity to look at the global equity fund. A lot of advisors I'm talking with right now are splitting the difference because they see some upside potential for USD. But that's an option, global equity or split with the North American. So question, why not allocate the whole portfolio to your funds? To be honest, I don't think that's actually a good idea. We might have some difficulty. We are a very tactical manager, and that's why we're really pushing an argument as a tactical sleeve. A lot of managers are fundamental. A lot of advisors are fundamental managers. A lot of advisors are buy and hold. And we're really having the opportunity to have us as a tactical sleeve to overweight, underweight equities and fixed income, to overweight, underweight international and US. I'm not going to argue if you want to, but the reality is I think it's a better overall portfolio if you have a tactical component to some of the longer buy and hold positions. And that's exactly what we come up with. People might be using SIA diligently on a daily basis, but the reality is there are some positions that you're going to be holding and you're not going to be selling them because of embedded cap gains, because of emotional attachment, whatever. I had a question, I think it's for Jeremy, more of an observation. To confirm the bull trap, bonds have barely moved in the past 2 days while the markets have rallied and the VIX was up yesterday and again. Do you have any comments?
Yeah, and in my view, this does look like a bull trap. You know, certainly the markets have been extremely oversold here for some time. Sorry, I went a little bit too far here. I should probably just go to this chart right here. So we've been extremely oversold. This bounce back here, you know, in traditional bear markets, we would expect this to happen maybe over weeks or even a month. The amount of activity, maybe one big day or a short squeeze for a couple of days, and then some sideways movement. If we look back to, you know, 2008 as an example of that, you will see at the top part of this bear market that we moved sideways up and down, just hitting lower lows every time before we had a big downturn. And then after that big downturn, we did the same thing, moving sideways, hitting lower lows right up until we got into December of 2008. We had one set double top, which would have been the first bullish signal since June of 2008. And then it gave it all back very, very quickly over that time frame. So the VIX has moved up quite dramatically, and we're certainly watching that, and that's why we think we still see bear market status. We're certainly not overly confident, given the charts we showed from the beginning, that this is going to turn into the bottom of the market, but we'll see. There is still a small chance that that could happen. If so, we've highlighted on the charts previously to this, sorry, going headed in the wrong direction, where we see some opportunity for the green zone to come back in, even if it happened today.
Okay. So a couple of things. Again, we, if you haven't known, we put up a YouTube channel where we post all of these webinars as a YouTube. We also will do a replay link. I know there are some issues with dialing in or audio. It's a good thing, but I think all of these types of remote webinar type things are being strained at the moment. But we'll provide the slides, we will provide a replay, and we will provide a YouTube clip of this webinar on video. Last question, Jeremy. What is the biggest factor that would turn the EAC from red to yellow to green?
Very good question. I'm just going to punch down here right into this. The biggest factor is we've already got one of the alternative asset classes, commodities, which is at the bottom. That's one of the reasons why we stayed in the green zone a little bit longer than maybe some people would have expected. Traditionally, we would see equities sliding commodities really got banged up, specifically to the oil war between OPEC and the Russian government. So that created a bit of a wrinkle. But commodities near the bottom, we see bonds deteriorating. So seeing currency and cash at the top would suggest that we would move a little bit faster. Traditionally, you would see bonds sitting at the very top part. When we've moved into the yellow zone in previous situations, we've had opportunities to buy bonds. We wouldn't have that opportunity if we moved in the yellow now. So comparing it to currency, comparing it to cash against equities are faster moving indicators than bonds and commodities, which still have potential upside, even if equities are moving. So the likelihood of this, if it was to be a bottom today, this to rotate fast would be greater from there, moving from the red into the yellow and then subsequently into the green. So we don't like to forecast. It is a complicated algorithm behind the scenes. It has served us well going back over the years from its original indicators that I used in 2000, 2002, and then the EAC here in 2008 has worked well. Even in 2011 and 2016, the EAC, when we went into the red zone, we ended up getting back in, didn't hurt us. We saw it slightly positive in 2011, slightly negative in 2016, with most of that negativity coming from a currency call, not from the EAC if we just held cash from there. And that's why we have that variety of products with cash, as Ted mentioned earlier, where you can be in Canadian or US if you'd like to.
Yeah. So again, that's very important to understand is we're not predicting. Our goal, and it's always been our goal, and it's been Jeremy's goal since he started this as an advisor, was to manage that downside risk. If you can avoid the worst of a bear market, you're far better protected than going forward. And that's exactly what we're trying to do here. We don't know how if this is a bottom, we don't know if it can get worse. Neither does anyone really. And what we're trying to find here is some sort of risk management and to actually do something. We could ride this down and ride this back up, and at the end of the day, you might miss out on a few years of gains for your clients. And what we're trying to do is have that conversation. So that's where SIA, again, Wealth is trying to help in terms of a tactical sleeve. That's where SIACharts is helping in terms of helping you act upon some of these signals and unemotionally, because that's one of the biggest things I hear every day is because markets can go up and down on a daily basis, is that emotion is riding a roller coaster. And that's exactly what we're trying to avoid here. So if you have any questions, obviously we're always here and available. We're going to do these webinars on a weekly basis, so we'll do one again next Wednesday until the panic subsides a bit. And again, we do have these available on YouTube. If you search up SIA Wealth, they should pop it up, and we'll make sure that everyone has slides as well. If you have any questions, feel free to reach out. But thanks everyone. Stay indoors, stay safe, and wash your hands. Thanks again for joining us.
Thank you, everyone. And to questions that we didn't get, we'll handle those by email, and we'll send out links for replays as well. Thanks again for your time.